You know, Tony, it's something that we've talked about. I know not a lot of people do. Maybe we're insane. Who knows? But when you look at the number of companies and the available equity that are out there, if you got the same number of people chasing half the available assets, you don't need to be a PhD economist to think that the path of likely resistance is higher.
Well, hey, Brian, good morning. Yeah, I think there's some validity to that. And I think that the related issue right now that is really helping to drive markets higher is the amount of liquidity that the Fed has injected into the system. It's expanded its balance sheet this year by $2.5 trillion. And so what happens is the liquidity that's been injected into the system pushes interest rates so low, not just at the Fed funds rate, but out the entire curve, that the attractiveness of holding bonds is very, very low. And so what you're talking about is a long-term structural issue, which is not necessarily any more active today than it has been over past years. But when you put on top of that the fact that we have a level of liquidity that's been put into the system by the Fed, which is massively impacting the bond curve, and then you have the buybacks that you talked about, yes, that all does conspire, if you will, to push equity prices much higher, particularly when real rates are much lower than dividend rates today. We've never seen that before.
And that's it. And you know, I know it. You can hear about it already. You can, in your mind on social media, Tony, the people say, well, this is all the Fed. It's all the Fed. And maybe it is. Maybe, Tony, it is all the Fed. But there is an old adage, you don't fight the Fed, and it has been proven true again and again and again. And you can hate what the Fed is doing. You can hate the debt levels. You can worry about our kids' and grandkids' future. But you cannot discount the fact that when a couple $1 trillion are thrown at a shrinking pool of assets, prices are going to go up. But does it have an unhappy ending, Tony?
Well, so that's just it. And there's one other factor I would point to that, in fact, impact the structure of the markets. And then I just think it's worth noting that the nature of the risks that we're confronting today and the way that those risks are transpiring, sort of the phenomenology of the market, if you will, is such that the good news is sequenced in the short term to be much more positive than potentially longer out into the year. So what I'm talking about is when you look at investor positioning, what you see is that investors, retail investors, institutional investors really don't change their positioning that much from month to month. What does change quite dramatically is the positioning of hedge funds and algorithmic and program investors. So they have those very high frequency trading participants in the market have the ability to really push the markets around in a magnified way. Now, what's happening right now is that when we look at the principal risks that we face, which is a second wave on the coronavirus and the success of the reopenings, and then ultimately, do we get a vaccine? And bouncing off a very, very severe economic slowdown that we saw in the second quarter, we are set up to get good news on all of these topics in the short term. It's unlikely we're going to get a massive second wave before middle to late summer, but then the risk increases significantly. It's unlikely that we're going to get significant negative news on vaccine trials that are in phases 1 and 2 in the short term. But when we get into phase 3, that risk increases significantly. And it's unlikely that the market is going to meaningfully price in a Democratic outcome in November right now, given all the other issues that are immediately present. But that's going to change as we get to the conventions at the end of the summer. And so when you put all that together, what you see is these professional investors in the market responding to all the positive news, but that's going to change. And the ability for those professional investors to support the market may reverse itself violently later in the summer.